Hi, I'm Rudy Martin for Uncommon Wisdom Daily. I'm often asked why I recommend stocks when global economic growth is slowing, especially emerging market stocks. The answer is that they often pay handsome dividends. Granted, emerging markets are facing some strong headwinds right now. Concerns about the European sovereign debt crisis and slowing economic growth in the United States and China have prompted fund managers to seek less risky investments. As a result, the MSCI Emerging Markets Index has dropped 17% over the last 12 months. Some recent economic data show that things may be looking up for the U.S., but in Europe, it's a different story. Investors were disappointed by a recent comment from ECB President Mario Draghi ruling out a program of quantitative easing. The markets had been hoping that the central bank would step in and buy the government debt of struggling Eurozone nations. So the market climate for stocks over the next several weeks is likely to be very unfavorable. But if you're willing to ride out some volatility, you should be able to find some great values in the emerging markets. I say that for several reasons. One, China is taking its foot off the monetary brake. Policymakers there know that the economy is slowing down. The manufacturing sector actually contracted in November for the first time in nearly 3 years. And China's consumer price index fell to 4.2% on a year-over-year basis, the lowest it's been in 14 months. In response, China's central bank lowered the reserve ratio requirement for banks in an effort to add liquidity to the markets. And continued weak economic Chinese data could open up the door to full-fledged monetary easing. Meanwhile, in India, they've been considering allowing foreign retailers greater access to the massive middle class. This could boost sales for a wide range of companies in the country's $450 billion supermarket sector. In Brazil, there too, the environment is becoming more hospitable for international investors. Last week, the country eliminated the tax it charges foreign equity investors and cut interest rates by 50 basis points. And finally, Russia is showing signs of catering to minority shareholder interests. The energy giant Gazprom announced a major change in its corporate policy. It's reserving $6.5 billion a year to pay investors a 5% dividend. That move could also give a boost, by the way, to the Market Vectors Russia ETF fund, which allocates 9% of its holdings to Gazprom shares. Now, all these changes are not likely to generate overnight bounces. It may take 3 to 6 months for new lending and monetary supply to increase, especially in the case of China and Brazil. In the meantime, look for bargains in emerging market stocks that pay solid dividends. I'm Rudy Martin for Uncommon Wisdom Daily. Thanks for watching.